Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Quantitative Easing and Unconventional Policies. Quantitative easing and unconventional monetary policies have gained prominence as tools employed by central banks to stabilize economies during periods of significant financial distress. Understanding their mechanisms, implications, and effectiveness is crucial for comprehending modern monetary policy's role in shaping economic outcomes. Quantitative easing involves the large-scale purchase of financial assets by central banks to inject liquidity into the financial system, lower interest rates, and stimulate economic activity. Unconventional policies encompass a range of additional measures that central banks may adopt when traditional monetary policy tools, such as lowering short-term interest rates, become ineffective, particularly when these rates approach the zero lower bound. Quantitative easing was prominently deployed by central banks during the global financial crisis of 2008-2009 and the subsequent economic downturn. The Federal Reserve, the European Central Bank, and the Bank of Japan are among the central banks that have implemented QE programs. By purchasing government bonds and other financial assets, central banks aim to increase the money supply, lower long-term interest rates, and encourage lending and investment. The intended effect is to boost economic activity by making borrowing cheaper and increasing asset prices, which in turn should lead to higher consumption and investment. The theoretical underpinning of QE is rooted in the portfolio balance channel. When central banks purchase long-term securities, they reduce the supply of these assets in the market, driving up their prices and lowering their yields. Investors, in turn, may shift their portfolios toward riskier assets, such as corporate bonds and equities, reducing yields on these assets as well, and stimulating broader financial conditions. Additionally, by signaling their commitment to maintaining low interest rates, central banks can influence expectations about future monetary policy, further supporting economic recovery. Empirical evidence on the effectiveness of QE is mixed, with studies suggesting varying degrees of success in achieving its objectives. For instance, research by Gagnon et al. Found that the Federal Reserve's QE programs significantly lowered long-term interest rates and boosted asset prices. Similarly, the ECB's asset purchase programs have been credited with reducing borrowing costs and supporting economic growth in the Eurozone. However, the effectiveness of QE can be influenced by various factors, including the state of the financial system, the credibility of the central bank, and the broader economic environment. One of the primary criticisms of QE is that it can lead to asset bubbles and increased inequality. By driving up asset prices, QE disproportionately benefits wealthier individuals who hold a larger share of financial assets. This can exacerbate income and wealth disparities, potentially leading to social and political tensions. Moreover, prolonged periods of low interest rates can encourage excessive risk-taking by investors, potentially leading to financial instability. Policymakers must carefully weigh these potential side effects against the benefits of QE in stimulating economic activity. Forward guidance is another unconventional policy tool used by central banks to influence expectations about the future path of monetary policy. By providing clear and transparent communication about their policy intentions, central banks can shape market expectations and influence economic behavior. For example, during the global financial crisis, the Federal Reserve and the Bank of England used forward guidance to signal their commitment to keeping interest rates low for an extended period, thereby supporting economic recovery. The effectiveness of forward guidance depends on the central bank's credibility and the clarity of its communication. The implementation of unconventional monetary policies raises important questions about their long-term implications for central banks' balance sheets and their ability to conduct monetary policy in the future. The large-scale asset purchases associated with QE have significantly expanded central banks' balance sheets, raising concerns about potential risks and constraints on future policy actions. For instance, the Federal Reserve's balance sheet grew from around $900 billion before the financial crisis to over $4 trillion at its peak. Managing the normalization of balance sheets and unwinding QE programs without disrupting financial markets poses a significant challenge for central banks. Moreover, the reliance on unconventional monetary policies highlights the limitations of traditional monetary policy tools in addressing deep economic downturns. The zero lower bound on nominal interest rates constrains central banks' ability to use conventional rate cuts to stimulate the economy, necessitating the use of unconventional measures. This has led to calls for a reevaluation of the monetary policy framework and the consideration of alternative tools and strategies. For example, some economists have suggested the adoption of higher inflation targets to provide greater room for conventional rate cuts in future downturns. In conclusion, quantitative easing and unconventional monetary policies have become essential components of central banks' toolkits in addressing economic crises and supporting recovery. While these measures have been effective in lowering interest rates, boosting asset prices, and stimulating economic activity, they also pose challenges and risks, including potential asset bubbles, increased inequality, and constraints on future policy actions. The ongoing evolution of monetary policy frameworks and the development of new tools will be critical in ensuring central banks' ability to respond effectively to future economic challenges. As such, a comprehensive understanding of QE and unconventional policies is vital for analyzing the effects and implementation of modern monetary policy. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.